Welcome back, ladies and gentlemen. We are going to talk about Donald Trump versus Kenneth Cordell Bedpost Griffin. And if you don't know why he's called Bedpost, is because his ex-wife alleged in the divorce proceedings that Kenneth Griffin threw a bedpost at her in the middle of an argument. So that is the kind of allegations we're dealing with, plain and simple. Check this out, my friends.
News that its CEO, Devin Nunes, sent a letter to NASDAQ warning of potential market manipulation from short sellers. The company also sent shareholders detailed instructions on how to avoid loaning out their DJT shares to short sellers. Well, the company's shares right now, they're up by about 12%. And there were some insider trading allegations that came forward and I think were ultimately proceeded with. So short sellers, one thing, insider trading, another thing. There's been a lot swirling around this company that still is so detached from fundamentals at this time.
Yeah, and the letter here being sent to NASDAQ CEO Dina Friedman, just asking for help to prevent some of this illegal naked short selling, at least from their perspective, that's happening right now, trying to make sure that there is a disclosure there on these short positions. You're seeing the reaction play out in the stock once again today, now to the upside, adding even more volatility to a name that has really traded all over the place since this merger was done here. And we know it has garnered much retail investor interest here over the last couple of weeks. We've seen the wild swings in the stock, well off the highs that you can see right there on your screen just after that merger had been completed at the end of March here. Now here we are trading just above 33 bucks a share.
Yeah, help. People don't like us. They're trying to crash our stock. We need help. All right, welcome to the public markets out here.
And you can see the mainstream media seems to be writing it off as they usually do, because of course the mainstream media being owned by some of the largest corporations out there that significantly have been known in history to manipulate markets do not want regular everyday people to believe that naked shorting and operational shorting and market manipulation are actual serious issues. We are looking at history in the making, as my friend Edward here says in the comments, ladies and gentlemen. And it is Ken Griffin versus Donald Trump right this very moment. Ken Griffin in 2022 said that Donald Trump is a 3-time loser and should yield to Ron DeSantis. I don't know if you guys have seen the polls lately, but I've seen them. I'm sure everybody else has. And it seems Ken Griffin was wrong again.
So in the United States, in both parties, the people that are running for the office of president, they're on a mission on their own. And they're going to do what they're going to do.
The process has to play out.
The process has to play out. Now, I really do hope that President Trump sees the writing on the wall. He lost in 2020. We lost Georgia because of his behavior.
Can you say election fraud?
In 2020. That's a second loss. And then this year, the Republicans lost the Senate because the Trump-backed candidates in the Senate races were rejected by American voters. That's a 3-time loser. And I'd like to think that the Republican Party is ready to move on from somebody who's been, for this party, a 3-time loser.
The process will play out, but you can influence the process. You've demonstrated most recently in Illinois, from a state from which you just
As you can see, Kenneth Griffin and Donald Trump do not get along whatsoever, and he has given $32 million to Nikki Haley's abysmal presidential campaign so far. He also gave $11.5 million between Senate and House Republicans, $10 more million to Maryland's future to back the Senate bid of former Governor Larry Hogan, a Maryland Republican, $5 million to fund conservative veterans groups, and $2.5 million to a Midwest Republican group. As Washington and Wall Street, of course, the swamp, have to maintain their quid pro quo to steal from the poor and give from the rich. And as you can see, our man Donald Trump has called him out several times now.
I appreciate it, Brian. Mary Erdoes, J.P. Morgan Chase. They just announced earnings, and they were incredible. Where are you? They were very substantial.
Of course, this was in 2021 here when he called out Cohen probably Steve Cohen and Kenny G as well.
You say thank you, Mr. President, at least? Huh? I made a lot of bankers look very good, but you're doing a great job. Say hello to Jamie. I think we're seeing him tomorrow. Nancy Falotoko of Ford. Nancy, where are you? Hi, Nancy. So young. So young. That's very impressive. Thank you very much. You're doing a good job. Jim Fitterling, Dow Chemical. Incredible company. Jim?
Let's skip forward here.
Ken Griffin, Citadel. What a guy he is. Where are you, Ken? Where the hell is he? He's trying to hide some of his money. He doesn't want to stand up. Where the hell is Ken? See, Steve, you'll stand, and he's very quiet about it. He's in here someplace. He's Sterling, Dow Chemical.
Where's Ken Griffin? He's trying to hide some of his money.
Incredible company. Jim? Thank you, Jim. Jack Fusco, Chenier. Jack, thank you. Great. It's a straw. He goes like this on oil pops. Harold, my friend.
So as you can see, they do not get along whatsoever. And Trump Media has made an update to an FAQ here on their website to provide tips on how to prevent the stock from being naked shorted. And of course, as you guys have seen, there has been significant shorting on the stock for DJT as well.
Ken Griffin, Citadel. What a guy he is. Where are you, Ken? Where the hell is he? He's trying to hide some of his money. Look, he doesn't want to stand up. Where the hell is Ken? See, Steve, you'll stand, and he's very quiet about it. He's in here someplace. He just doesn't want to stand. Harold?
That's fantastic. We'll get to that next here shortly. But taking a look at this chart, you can see that DJT made Trump $4.5 billion in a matter of a few days as the stock price rose from $16.90 a share to a high of $71.90 a share in a matter of a few months as well. You can see the 52-week high was $79.38, coming up from a low of $12.40, currently sitting at the $36.24 mark. As you can see here, the Trump media is making a point of telling its shareholders how to prevent their stock from being loaned to short sellers. Because, of course, this is a very serious issue. And he's come out on Truth Social and said, rather than support our common sense efforts to promote transparency and compliance, Citadel Securities bizarrely targeted our CEO with an unhinged attack. Truth Social talking about Kenneth Cordell Bedpost Griffin, who is discussing and attacking Donald Trump. Truth Social said, Citadel Securities, a corporate behemoth that has been fined and censured for an incredibly wide range of offenses, including issues related to naked short selling, and is world famous for screwing over everyday retail investors at the behest of other corporations, is the last company on earth that should lecture anyone on integrity. And I think they make a very good point. As you can see here, as of April 3rd, 2024, Trump Media became the most expensive stock in the world, in the United States, to short by a far, far margin. They began being publicly traded in late May and is currently one of the most expensive stocks to sell short, period, according to S3 Partners. Investors who wanted to borrow shares of Trump Media to sell them short in the beginning of April had to pay financing costs of between 750 and 900% of the price of the stock annually. Meanwhile, existing short positions in Trump Media are paying costs of 565% cash annually. This is absolutely huge. Now we should save this one here and bring that up a little bit later. And as you guys may or may not know, Donald Trump retruthed on Truth Social in 2022 in regards to AMC and GameStop, another heavily shorted stock, two stocks. DWAC is the SPAC, the Special Purpose Acquisition Company, bringing Truth Social and Trump Media and Technology Group public. Facebook rebranded almost the moment TMTG was announced and has since lost $400 billion in value. DWAC's share prices at the time gave TMTG a post-merger roughly of $10 billion. Hat tip to GME and AMC investors for exposing Wall Street corruption on an unprecedented level. And now Donald Trump is taking that a step further by talking about this in the public eye, because a lot of people still don't understand that naked shorting directly affects your pensions, your 401ks, your thrift savings plans, you name it. Naked shorting affects you, even though you may not be able to see it. He continued to say, good report said, which was retruthed by Donald Trump, it's time to apply lessons learned to the most feared company on the market, one with a future and fundamentals, and one that also restores our voice. And it seems that shorts are still hard at work with a large amount of short volume on DJT, on AMC, on GameStop. And they're coming out and giving tips as they've reached out to the NASDAQ to advise them of the naked shorting and market manipulation. They've said it certainly shows concern about short selling of Trump media stock, said a business professor from the University of Southern California. Here we go. As you guys may know, former President Donald Trump is by far the biggest shareholder in Trump Media, owning nearly 60% of its stock, and his 78.7 million shares could grow by 36 million if their price stays above $17 per share, due to an earnout provision in the merger deal that took the company public. As you can see here, it was up 9.6% today, as well as AMC stock was up over 9% today for a majority of the day as well. And they are being called out, Citadel Securities is being called out by Truth Social and Donald Trump as well. But I absolutely love that he's retruthing and sharing information about AMC and GameStop as well. And as you guys may know, Jim Cramer is bullish on banks. This means that it is likely time for the banks to go the way of the buffalo. Let me move myself out of the way. Just on Wednesday, Jim Cramer said he is generally positive on major banks' earnings as well. But Nvidia has fallen 20% from their all-time high and is now officially in bear market territory, as they have erased over $400 billion worth of their market cap since just about a month ago. And meanwhile, we're seeing SMCI today, super microcomputer, down 40% from its recent all-time high. These large cap chip stocks are falling even faster than they were pumped over the last few months. And with good reason as well. Take a look at the yield curve inversion. We've literally only seen this 3 times in the entire history of the United States financial markets. And all 3 times, we saw the stock market draw down over 50%. This was 1929, as you can see here, 1974, and of course, 2008 here. We may be looking at the final rally before the recession that we're currently in actually kicks in. And as my guy Edward said here on Twitter, the fire sale is now brewing. SMCI came crashing down today, 23%, followed by Nvidia, another 10%, and the SPY being down over 5.3% for the month, sliding down from 525 to 495. The big 7 piles of Ponzi scheme trash are the only thing propping up the SPY and the, quote, economy is in good shape narrative. Citadel and BlackRock are running computerized high-frequency trading algorithms to maintain their books, but someone is very unstable. At the same time, Donald Trump is exposing Ken Griffin and Citadel and other market-making criminals. The big reveal is going to happen very soon. And as we've discussed, they are definitely having at it. Take a look at the chart of SMCI, negative 23% today, from 935 to 708 a share. Unreal. It is about fucking time. Why do we say that? Because this Ponzi must end, like all Ponzis eventually do. Take a look at Nvidia, down 10% today. Huge. Huge for a stock that holds up the majority of the stock market. These 7 stocks hold more weight in the stock market than the other 493 in the S&P 500. And of course, that's what's helping to pull down the S&P 500 from its ridiculously high overvaluations. As Truth Social and Donald Trump continue to take on market makers, naked shorts, and Kenneth Griffin. Take a look at the Fed borrowing window, ladies and gentlemen. Do you think this is just this is not real? You think this is a game? This is major liquidity here that is being sucked out of the system, and they've got a long way to go. Just in the last couple days, from 4 days ago, the liquidity and credit facility, which is the Fed discount borrowing window, loans were at $5 billion that were being used by banks in order to maintain their margin. As of April 17th, this past Wednesday, that number jumped from $5 billion to $8.559 billion. These are massive jumps in the Federal Reserve's discount borrowing window loans. Take a look at this post from Lit Exchange, LLC. Repo loans today were also taken out for over $112 million. In addition to the discount borrowing of $8.5 billion, there was another bank that needed another $112 million in Treasury repo loans. This is not reverse repo. This is actual repo. This means we're in trouble and we need help now. And on top of that, the reverse repurchase program, the reverse repurchase operations were also collapsing. Take a look at this. Sorry, hang on one second. Got to shut that off. All right, my apologies for that, ladies and gentlemen. A few days ago, this fell down to $327 billion with only 62 counterparties on the reverse repo program. And again, this is basically on track to be depleted by the end of May. The Treasury uses these money market funds in the reverse repurchase operations to buy U.S. Treasury bonds. This reduces the yield curve inversion artificially. The RRP is down, as of that day, $80 billion today from the high of $2.56 trillion in 2023. This was a typo. It was at $2.56 trillion in 2023, over $480 billion a few days ago, and is now in the 300 billions. Trillions of dollars in bonds need to be rolled over this year, and there is insufficient cash in the monetary system, in the mutual market funds, to prevent bond auctions from going no bid. This creates a further inversion of the yield curve and decreases in existing bond values. Non-reverse standard repo operations, which we just discussed, are increasing to new highs not seen since the COVID-19 crash. That's over $150 billion now. These 12-month loans are used by banks as collateral maintenance margin to prevent margin calls on their naked shorts and short positions. Markets are a lie, and the truth will be felt by everyone the world over, without question. So much so that even the former president of the United States, who is likely to become the next president of the United States, is also calling them out directly on social media, on television, because this does deserve to be heard by more people, because it is not well known. If the Fed prints more money to inject liquidity into the reverse repo operations, or to bail out the money market funds as they did in September of 2019 when it started to implode and they had to take over and print billions and billions of dollars to save these banks, inflation will roar much higher than what you're currently seeing. And that will lead to conditions that will cause even more pronounced financial market crashes in the future. They can kick the can, but it'll just be a more massive explosion from the volcano when these fake markets come crashing to reality, when an actual black swan causes a tidal wave of defaults across financial markets. And speaking of that, market maker Virtue Financial, they have a debt that is skyrocketing and has increased in 2023 by over 42%. And over the last 6 years, their stock is down from the March 2018 highs of $37 a share to currently $20 a share, with a wonderfully low 1% return on average assets. Look at their skyrocketing debt. Long-term debt is absolutely shooting through the roof. Their total debt growth is up 42.85%. And they have $134 million worth of deferred taxes on top of that, with over $2 billion in long-term debt and 1.7 excluding capitalized leases. This is the liquidity fairy, as people like to call him, Doug Sifu of Virtue Financial and his company, who is down nearly 50% over the last 6 years. The difference is that retail investors are not diamond handing or holding Virtue Financial. Virtue Financial has the ability to make their own market. They have their own hedge fund with which to prop up their stock. And they could still not prevent it from going down 50% over the last 6 years. Again, speaking of banks, as Jim Cramer is bullish on the banks, ISDA is freaking out over the new regulations being implemented by the Federal Reserve that forces them to maintain higher margin collateral and increases their capital requirements and their minimum margin requirements. They are posting tweet after tweet about them crying and bitching and moaning about the U.S. Basel III regulations. They state this will result in an 80% increase to the cost of clearing at a time when firms are talking about liquidity risk. They say we've switched from counterparty credit risk to liquidity risk, and the Basel III rules are not going to help that, says Jane Rowe of ICE Markets, who is one of the market makers as well. At the same time, this is not just U.S. banks, although Jamie Dimon is selling off massive amounts of J.P. Morgan Bank. UBS is currently getting cash called by the Swiss government because they know that the threat of the bank's insolvency is very, very real. At the same time, they're facing a $20 billion capital hit under the Swiss bank's plan because of a ridiculous amount of swaps and derivatives that they hold, a lot of which is legacy costs from Credit Suisse that were incurred from Archegos, naked shorting via the use of swaps, stocks like AMC and GameStop. UBS will need to hold billions more in capital, says Kristen Shaughnessy, and she was absolutely right. They are incredibly worried about them collapsing, and they need to have more capital to offset that risk. Their banks are saying it'll make banking more expensive for investors, but bank bailouts, as you guys know, are ridiculously expensive for regular, everyday taxpayers such as you and I. and we're looking at banks' earnings reports, this is earnings week for these banks. Bank of America stock was down -5% after they reported a huge earnings downturn because their profits were down 18%. Jamie Dimon sold $33 million worth of JP Morgan stock a few days ago, per a most recent SEC filing. PNC Financial said their net income fell 22% year over year. And M&T Bank net income dropped to $505 million. And of course, the KRE banking ETF is going to be reflective of that fact. Look at the way the banking sector has diverged from the S&P 500 because the SPY is, of course, being propped up by the Magnificent Seven. The FANGMAT stocks is what people used to call them. Why they started calling them the Magnificent Seven is really, truly ridiculous. And discussing UBS and Credit Suisse, you can see here from this article from 2021, the firm Archegos, behind the $30 billion fire sale shaking financial markets, disclosed almost nothing. And that's the exact same thing that we're seeing now from these companies that are disclosing nothing in regards to their swaps and short positions, rehypothecations, naked shorts, operational shorts, married and divorced puts, synthetic shares, phantom shares, tokenized shares that are non-existent, and so on. I can go on forever, but I'll stop there. Up until recently, Archegos Capital Management reported a $30 billion financial fire sale that battered stocks worldwide. And that is exactly what is currently happening in the fire sale that we're seeing on these financial markets. These drops with SMCI dumping 23% in a single day. They skipped the pre-announcement for their earnings. That's not a sufficient reason for a 23% drop in the stock. Somebody always knows. Somebody always knows what is coming next. That is why even Donald Trump and Truth Social, who are well aware of what's going on, is calling them out by name. By name. And he's absolutely right to do so. As you can see here, people who say managers who think the stock is undervalued aren't going to be overly concerned about short sellers, he said. Wow, maybe he's talking about AMC, GameStop investors who understand that a stock's being undervalued make them a serious value play. Not to mention the potential for incredibly high and fast volatility, leading to short squeezes. And multiple times now we have seen runs of over 1,800% in the stock prices of AMC and GameStop. And even more recently, DJT. So don't you forget it, ladies and gentlemen. We have one more here. I have one more tweet I want to share from Edward. Let me pull this up. But of course, we've got Doug Sifu, the liquidity fairy.
If there's not liquidity on a lit exchange, fundamentally the wholesalers are providing infinite liquidity at the NBBO or the inside price. So if we get an order for 1,000 shares in Reg NMS stock that no one's ever heard of, and there's 200 shares on NASDAQ in New York, we fill out 1,000 shares at that inside price. That's meaningful liquidity. 55% of the orders that we received, Bob, we provide size improvement. In a complete, as he calls it, an auction environment, who's going to provide that?
They're worried that when the auction is available and the orders are no longer being directly routed using payment for order flow to their dark pools for them to create synthetic shares, that they will have to compete with the New York Stock Exchange and with others in order to actually allow the national best bid and offer to reflect the accurate prices of stocks and shares. That is Doug Sifu, ladies and gentlemen. The liquidity fairy of Virtue Financial. What do you got here in the 8K? Looks like AMC paid down some of its revolving credit facility. New 8K filing for AMC. This is live information that just came to me from the think tank. Thank you, ladies and gentlemen, for sending this my way. This is a brand new 8K filing for AMC that just dropped. Let's read it. This is the first time I'm getting the chance to take a look at it. As previously disclosed, AMC's $225 million senior secured revolving credit facility matures April 22nd of 2024, and the company does not intend to renew the facility. The company has entered into a new letter of credit facility in order to continue to provide letters of credit in the ordinary course of business. The senior secured revolving credit facility included a financial covenant that required compliance with a certain secured leverage ratio. That means, for those of you that are unaware, that the reason that AMC had to sell shares on the open market was to make sure that they had sufficient cash on hand to meet this facility's requirement. That's why AMC had to do a share issuance. Now that they've got nearly $1 billion in cash on hand, according to this, let's continue reading, they may not ever have to do that again. However, the requisite revolving lenders previously agreed to suspend testing of the revolver financial covenant through the testing period ending March 31st of 2024, subject to certain conditions, including a minimum liquidity requirement of $100 million. Now, as of April 19th, and in anticipation of the maturity of the facility, the company voluntarily terminated the commitments under the senior secured revolving credit facility in full and paid off any remaining obligations with respect to the senior secured revolving credit facility. Immediately from and after the revolver payoff, the revolver financial covenant and the related covenant suspension conditions are no longer in effect pursuant to the terms of the credit agreement. The termination of the senior secured revolving credit facility does not otherwise affect the terms. I believe we're looking at AMC debt restructuring occurring right now. They have paid off this revolving credit facility that forced them to maintain a minimum liquidity requirement, which is part of the reason why they had to sell several $100 million worth of shares of AMC stock. And now that they have sold the shares, they have nearly $1 billion in cash on hand, and they used some of that to pay off their revolving credit facility. This is absolutely fantastic news for AMC stock investors, in my opinion, which is great to see. Thanks so much for posting. Yeah, and there is a couple more things that prevent us from getting an AMC dividend as of yet. And those of you wondering why we're talking about AMC dividend is because when a dividend is issued, shorts have to pay for the dividend if there are shorts on a stock. That way, that means if there are billions of shares issued when only 320 million should exist, then the shorts would have to pay those dividends for all of those synthetic shares, thus costing them significantly more money, and that money wouldn't have to come out of the coffers or the money of AMC stock or the business. It would come directly from the short hedge funds, market makers, institutions, and so on. Let's see, Plown says they decided not to renew their $225 million credit line, paid off any remaining debt under it, and no longer has to follow certain rules related to that credit line. That's exactly right, my friend. Plown, very good. Don't know if that can get us dividends, as I don't know which one actually holds that covenant. There are several covenants in the 2026 debts that are still owed by AMC that prevent them from issuing a dividend. But that doesn't mean that we're not significantly closer to that being a possibility, just so you guys know. Yep, let's take a look here. This is John Merriweather from AMC Theaters, has said in email in the past, via November 15th, 2023, our first lien and second lien debt and the corresponding credit agreement contain the covenants prohibiting the payments of dividends. The indentures for the first lien and second lien debt and the corresponding credit agreement would need to be changed to remove the covenant that prohibits. We routinely have conversations with our bankers regarding debt obligations. Very good. So they've already paid down one of them. Looks like there's only one left. And then AMC would be able to issue a dividend of whatever amount, and that would have to be paid by short sellers. I think shorts are fucked. Let's see. Bilbo says if President Trump is aware of Citadel, he should also be made aware of Tim Scott's defense of payment for order flow practices during the meme stock hearings after the buy button was taken away. That's an absolute great point, my friend. Here it is, directly from the SEC. Thank you for posting this back up, Edward. I wanted to show this to you guys. Fire sale risk mitigation. The SEC and the NSCC work directly to try to prevent margin calls and fire sales from occurring. But as you guys know, they have occurred dozens and dozens of times throughout the history of the stock market. The rule change that they're working on regarding borrower defaults and a potential fire sale scenario where all owners of affected securities suffer loss. The rule change will increase the availability of SFTs to NSCC members, even though SFTs are already a significant contributor to the underlying reason of member defaults. This indicates the rule change will potentially increase the level of negligent risk behavior of the NSCC members. And that's why we've seen a significant number of members actually leaving the NSCC, because they don't want to be stuck paying for it, because the clearinghouse NSCC is basically self-insured through the other members. When one has negligent risk, then the other ones have to pay for it. So they say in the event of an NSCC member default, they will only liquidate the net positions and not the gross positions of the participant. The justification is that less positions will be closed and therefore less price impact inflicted to the affected securities, aka the ones being fire sold, aka SMCI, Nvidia, Apple, Alphabet, etc., right? Meta. NSCC and remaining members are responsible for the open portfolio positions of the defaulting member, meaning that when Archegos collapses, Credit Suisse is responsible. When UBS reacts to the losses of Credit Suisse and Archegos, then UBS is responsible. Other prime brokerages and other NSCC members will be responsible, hence the domino effect, fire sales throughout financial markets. The only reason for a fire sale as a result of liquidation of the members' positions would be directly from their actions to close the positions haphazardly. The rule not only further facilitates NSCC member negligence, but it also facilitates the negligence of the NSCC itself. The rule enables the NSCC to limit their own loss as a result of member negligence. They literally only want to save their own ass and let everyone else underneath them take the damage. This removes the responsibility and the accountability from the NSCC as an SRO, a risk overseer, a regulator, a self-regulating organization, because, of course, they police themselves and give themselves a big pat on the back, say that they've done nothing wrong. They've investigated themselves and everything is fine. They've done nothing wrong. Liquidity drain risk mitigation. Generally, the paragraph does not warrant comment. It only redescribes that the NSCC members overextend their positions and create high-risk situations, which can have a far-reaching impact beyond the member itself and cause a market-wide downturn, which is potentially exactly what we're seeing right now with all of these stocks that we just got done talking about. And I showed you the chart so you could see it for yourself. It seems to be beginning already. If a borrower needs to reborrow a security to deliver it to a counterparty, that means that said borrower did not own the security. I'll say that again. If a borrower needs to reborrow a security to deliver it to a counterparty, that means the borrower did not own the security or have the security borrowed for the short sale, aka this is naked shorting and is illegal under SEC Reg Show provisions. Illegal naked shorting activity has been referenced again in the rule proposal and glossed over as a normal market activity, which it is in fact not a normal market activity. It has become normalized by shorts, but that does not mean that it is not illegal and a crime. Not to mention in China and Korea, people are now losing their licenses, losing their homes, losing their ability to trade on markets, and some of them even being sentenced to death for their white-collar crimes of naked shorting and embezzlements. So the remainder of the proposed rule change, said the SEC, only provides the details of the system that they would like to implement to further perpetuate illegal, negligent, high-risk behavior of NSCC members. There is significant reason to disapprove of this rule change. The proposal itself should be replaced with a new NSCC rule change proposal as to how they will reduce the vast market risk imposed by NSCC members to possibly include considerations such as increased capital requirements, which we also just got done talking about is what the Federal Reserve is doing with Basel III. And what is happening with that? Well, banks are freaking out, as we discussed. Regional bank stocks are falling. UBS is freaking out because they're getting cash called by the Swiss government. And ISDA is posting all over Twitter to try to convince people in their favor that Basel III requirements are unfair. What else? Their defaulting member portfolio unwinding procedures should be reviewed, as we saw what happened with Archegos caused the collapse of Credit Suisse, which will cause the collapse of UBS Bank eventually, and therefore leading and bleeding out into further market participants. NSCC obligations to make market participants whole from negligent member actions, etc. This is the reason why many of them are leaving, because these markets are a sham and they are being massively manipulated through the use of derivatives that are absolutely toxic and have the utmost risk of spreading to your investment accounts, your non-self-directed pension, thrift savings plan, 401k, etc., etc., and taking out a vast portion of the banking sector and the financial system. And I think it's about time that real changes are implemented to force them to stop the criminal behavior, to stop the naked shorting, to stop the operational shorting. So I could not be happier that Donald J. Trump is actually calling them out for their illegal actions. Because they're legal for a market maker to naked short a stock, and is legal for a market maker, such as Doug Sifu, as you guys heard earlier from Virtue, to sell shares he doesn't own. Ladies and gentlemen, I will leave you with that. I wish you peace and wealth. Have a great weekend. Oh, did I forget? No, I didn't forget. We're going to be filthy fucking rich.